Okay, let's unpack this. We're diving deep today into something that, well, promises a lot for investors, dividend investing. This whole idea of getting that steady income, finding those golden geese for your portfolio, it's really appealing.
It absolutely is. But as we've been digging into, beneath that appeal, there are some pretty significant risks. We're talking about potential dividend disasters.
Dividend disasters, yeah. Things that can turn that income dream into, well, a bit of a financial nightmare.
Exactly. And what we really explored is this key tension. How do you find those reliable income payers while also spotting the red flags, the signs that scream danger before a company actually goes and cuts its payout?
And that's critical because for anyone who's actually counting on those dividends, maybe for living expenses, maybe retirement, maybe just building wealth, a cut isn't just some number on a screen.
No, it's a pay cut, a real hit to your financial security.
Right. So our mission here in this deep dive is to pull out the really important signals and strategies from the material we've looked at. Stuff to help you protect yourself, avoid those big cuts. We want you to understand why these things happen and, more importantly, what to look for before you jump in.
And one of the first things that really stands out, kind of counterintuitively, is how often what looks like a fantastic opportunity
is actually the first warning sign.
Precisely. That brings us straight to that first major red flag we identified, the false promise of high yield.
Oh, the siren song.
Yeah, this is the classic trap, right? You see a stock, maybe it's yielding 11%, 12%, something way higher than the market average, which is, maybe 1.5%, 2%?
Yeah, tiny in comparison.
So you think, wow, I found a bargain.
A hidden gem. The analysis we looked at is pretty clear on this, isn't it? If it looks too good to be true.
It almost always is.
Yeah.
And the reason why a yield gets artificially inflated like that, usually it's because the stock price is collapsing.
Right. The math just works out that way. Yield is the dividend amount divided by the price.
Exactly. So if the dividend hasn't changed, but the stock price tanks because investors are worried, boom, the yield percentage shoots up. It's not a gift. It's often a sign of distress.
Or it could be that the company's just paying out way more than it should be relative to earnings.
That too. Or maybe the core business itself is shrinking and they're trying to, prop up the stock price or keep investors happy with a payout they really can't sustain long term.
The AT&T example really highlights this, doesn't it? Seemed like a dividend stalwart for ages.
Big payout. But as the stock price kind of drifted down over time, that yield just kept creeping higher and higher. Looked tempting on paper.
Until it wasn't. 2021, they finally had to face reality and slash it almost in half.
So the big lesson from flag number 1, don't confuse high yield with high quality. Dig deeper. It's often a warning, not a windfall.
Makes total sense.
Yeah.
Okay, so if that super high yield is the first lure, the material suggests the next stumble for investors is often looking at how the dividend is being paid.
Right. Which leads us neatly into the payout ratio trap.
Okay, payout ratio. That's the percentage of earnings the company pays out as dividends.
That's the one. And the danger sign here is pretty straightforward if that ratio is consistently over 100%.
Meaning they're paying out more money in dividends than they actually earned in profit.
Exactly. I mean, think about your own budget. If you consistently spent more than you earned month after month.
Yeah, that wouldn't end well.
Same for a company. It's just not sustainable.
Now, the sources did add a little asterisk here, mentioning things like REITs or MLPs, those real estate or pipeline companies.
Right, because their structures are different. Tax rules often require them to distribute most of their income. So a high payout ratio based on traditional earnings might be normal for them.
But even there, it's not a free pass, is it?
Definitely not. The analysis warns against getting complacent. These companies often use adjusted metrics. You'll hear terms like AFFO or DCF, adjusted funds from operations, or distributable cash flow.
Basically, their own ways of measuring cash flow available for payouts.
Yeah, but those adjusted numbers can sometimes be, let's say, creatively calculated or based on overly optimistic forecasts. Just because they say the dividend is covered by AFFO or DCF doesn't mean it's truly safe.
The Kinder Morgan example was pretty stark here.
Oh, absolutely. They were talking up their DCF coverage, telling everyone the payout was rock solid. Management was very reassuring.
And then?
Well, oil prices crashed in 2015. They got hit with a credit downgrade threat, and suddenly that safe coverage just vanished. They ended up having to cut the dividend by a massive 75%.
Ouch. So it's not just the number. It's the quality of the earnings or cash flow behind it.
Precisely. You have to look critically at how sustainable that underlying cash generation really is.
Okay, sticking with the financials, another huge threat that came up again and again was debt. the silent dividend killer.
This one's fundamental. Think about who gets paid first when a company is under pressure.
The lenders, the bondholders.
Exactly, the creditors. Paying interest and principal on debt, that's mandatory. It's a legal obligation. Paying dividends to shareholders.
Optional.
Totally optional. Dividends come after the debt gets serviced, so if cash gets tight...
The dividend is the first thing on the chopping block, potentially, because they have to pay the debt.
That's it. In a real crisis, there might be nothing left for shareholders after the creditors take their share. We saw this famously with GE General Electric.
A classic dividend stock for decades, right?
Absolutely, a portfolio cornerstone for many. But, years of complicated financial engineering, piling up debt, the core business weakening, it all caught up. They cut the dividend twice in 2018, then just eliminated it after decades of payouts.
And it's not just complex industrial giants. The material mentioned PG&E, the California utility.
Right.
Utilities are supposed to be safe.
You'd think so. Traditionally very stable income producers. But they got hit with massive liabilities from those devastating wildfires. Suddenly, they had these overwhelming debt obligations. Even a safe utility had to suspend its dividend.
Wow. So the lesson is, look beyond the income statement.
You absolutely have to. Read the balance sheet, understand the debt levels. A company carrying a huge debt load is inherently riskier from a dividend perspective because those creditors always come first.
Okay, moving beyond just the single company's books, the analysis also stressed, looking at the bigger picture, sector risk and the danger of overconcentration.
Yeah, this is crucial. Not all industries are created equal when it comes to stability. Some sectors, think consumer staples, toothpaste, toilet paper, or healthcare.
Stuff people need regardless of the economy.
Right. They tend to be more resilient. But other sectors, energy, industrials, a lot of retail, tech, sometimes they're much more cyclical. They boom when the economy's hot, but they can get hammered in a downturn.
Yeah, and the temptation is to chase yield into those cyclical sectors when they're riding high, maybe paying out more.
Exactly. You see a high yield in, say, an energy stock when oil prices are up, looks great, but then the cycle turns.
Like 2020 with COVID.
Perfect example. Oil demand just fell off a cliff. Now, the super majors, your ExxonMobils, your Chevrons, they had the balance sheets to ride it out and maintain their dividends. But a lot of the mid-sized players, Occidental Petroleum comes to mind, they had to slash or suspend payouts entirely because their cash flow just evaporated.
And it wasn't just energy, right? The retail REITs got hit hard too.
Oh, yeah. Companies owning malls, shopping centers, Simon Property Group, Tanger outlets. When lockdowns happened and their tenants couldn't pay rent,
the dividend payments downstream stopped.
But they had to cut. So the takeaway is pretty clear. Diversify. Spread your bets across different sectors. Understand which ones are prone to booms and busts, and don't load up on them just for yield. Mix in those stable payers.
Hey, now this next one kind of challenges a sacred cow for some dividend folks. The illusion of dividend aristocracy.
Ah, yes. The aristocrats. Companies that have managed to increase their dividend every single year for 25 years or more. Sounds bulletproof, doesn't it?
Yeah, like the gold standard of reliability. Yeah. Almost like they're immune.
But the material we reviewed really pushes back against that idea. Being an aristocrat is impressive, no doubt. But it doesn't grant immunity from market forces, bad management, disruption.
They're still just businesses at the end of the day.
Exactly. They operate in the real world. Yeah. And we saw this play out with VF Corporation. VFC owns brands like Vans, The North Face, Timberland.
They were an aristocrat, right, for a long time.
Over 50 years. Half a century of consecutive dividend increases. Really impressive history. But then, in 2024, cut. Significantly.
Oh, what happened?
The usual suspects, really. Earnings were struggling, costs were rising, and they were carrying a fair bit of debt from some acquisitions they'd made. That amazing 50-year history just couldn't overcome the current weak fundamentals.
So the lesson is, history is nice, but it's not everything.
Don't worship the past. You have to watch the current performance. That track record is great context, but it's not a guarantee for the future.
Good point. Okay, what about looking overseas? Red flag #6 tackles international stocks. Withholding taxes and currency risk.
Right. Investing globally can be great for diversification, maybe find some yields you don't see domestically, but it adds complexity big time.
Like taxes.
Yeah, first off, withholding taxes. Many foreign governments will take a slice of the dividend payment before it even hits your account. It's just automatically deducted.
So you might see a company advertising, say, a 5% yield.
But after the foreign government takes its cut, maybe you only actually receive 4% or even less in your pocket.
Can you get that back?
Sometimes. You might be able to claim a foreign tax credit on your U.S. taxes to offset some of it, but it's often not a dollar-for-dollar recovery, and it definitely makes your tax prep more complicated.
Okay, so that's one hurdle. What about currency?
That's the other big one. If you own shares in, say, a British company paying dividends in pounds or a Canadian one paying in loonies.
You eventually need that in U.S. dollars, right?
Exactly. And if the pound or the loonie weakens against the dollar between when the dividend is paid and when you convert it, or just over time, that eats away at your actual return. A good yield can get wiped out by bad currency moves.
The Telefonica example, the Spanish telecom, seemed relevant here.
Yeah, TFEL often pops up on high-yield screens, but the analysis pointed out it's cut its dividends several times. Why? Well, high debt, a kind of sluggish European economy. And for U.S. investors, the euro versus dollar fluctuation adds another layer of risk on top of that.
So you really need to know what you're actually going to end up with.
Absolutely. Understand the impact of taxes and currency. Don't just look at the headline yield number.
Got it. Next, something that feels like a bonus but shouldn't be counted on. The special dividend mirage.
Yeah, these are interesting. Sometimes a company will pay out a special or extra dividend. It's usually a one-off thing.
Why did they do it?
Could be after a really great year. Maybe they sold off a division or some assets, or they just find themselves with a big pile of excess cash they want to return to shareholders.
Sounds good.
It is good, but the key word is special. The analysis stresses these are not part of a regular, predictable income stream.
So you can't bake them into your income plan?
Absolutely not. Relying on special dividends is like planning your budget around winning the lottery. It's nice if it happens, but it's not reliable. Costco is a good example.
Right. They've done some big ones.
Yeah, like that $10 per share special dividend back in 2020. Fantastic for shareholders at the time. But you can't assume Costco's going to do that every year or even ever again. That's not their model.
And sometimes companies just pay one big dividend a year instead of quarterly.
Right. And those often function more like a variable distribution, maybe tied directly to annual profits or cash flow, rather than a traditional steady quarterly dividend. Again, fine, but you shouldn't confuse it with predictable income.
So treat specials as a nice surprise, not a staple.
Exactly. Gravy, not the main course.
Okay, final red flag. This one feels a bit more subjective. The role of management and capital allocation.
Yeah, it's about the people in charge. Even if a company has a great business, poor decisions by leadership can absolutely wreck the dividend.
Like what kind of decisions?
Well, the material pointed to things like management getting obsessed with empire building, making huge, risky acquisitions just to get bigger.
Loading up on debt in the process.
Often, yeah. Or maybe they pour money into vanity projects that don't generate good returns. Or maybe the strategy just shifts. Maybe a new CEO comes in and decides share buybacks or massive R&D spending are more important than dividends right now.
The Anheuser-Busch InBev example, BUD, seemed to fit the acquisition risk.
Totally. That massive SAB-Miller merger, they took on mountains of debt to do it. And ultimately, in 2018, they had to cut the dividend specifically to free up cash to pay down that debt. The acquisition priority trumped the dividend priority.
So the dividend isn't always the top priority for management.
It often isn't. Priorities change. Capital allocation decisions, where does the company's cash go? Reinvesting, buybacks, debt paydown, acquisitions, dividends. Those choices directly impact your payout.
So you need to follow the executives, not just the numbers.
You really do. Understand their strategy, listen to what they say about priorities, and watch where the money is actually going.
Okay, wow. That's a lot of potential pitfalls. 8 big red flags. So boiling it all down, what are the practical takeaways from the analysis for actually spotting these disasters before they strike?
Yeah, the material kind of synthesizes this into a useful checklist. First, be super skeptical of yield if it's way higher than its peers or the sector average.
Investigate immediately. Don't just accept it.
Right. Then payout ratio. Check it. If it's consistently over, say, 80%, especially outside those RITMLP structures, be very wary and critically look at free cash flow.
The actual cash the business generates after expenses and reinvestment.
Exactly. If that's negative or even just declining steadily, that's a huge warning sign. The cash just isn't there. That often comes before a dividend cut.
And debt. We covered that.
Monitor the debt. Is the debt-to-equity ratio climbing? More debt equals more risk to the dividend. And look at the basics. Are revenues and earnings actually going down? A shrinking business struggles to pay anything, let alone a growing dividend.
Are there other, maybe softer signals to watch for?
Yeah, a few. Keep an eye on insider selling. If the execs who know the company best are dumping their stock, maybe they know something you don't.
Makes sense.
Also, look out for accounting red flags, weird adjustments, or major lawsuits that could drain cash. Revisit that sector risk. Is the company too reliant on a shaky industry? And check the history. How did they handle the dividend in the last recession? Did they cut?
And how management talks about it.
Huge.
Yeah.
Listen to those earnings calls. Read the transcripts. Are they clear and direct about the dividend safety and their capital plans? Or are they kind of cagey, evasive? Lack of transparency is usually bad news.
Any specific tools or resources mentioned?
Yeah, use stock screeners that let you filter by payout ratio. Track that free cash flow trend over multiple quarters, not just one. Maybe set up alerts for credit rating changes from Moody's or S&P. A downgrade is a clear risk signal. And yeah, actually read the 10Ks, the annual reports, and those earnings call transcripts. That's where the real nuggets are often buried.
Okay, so that's the defense, spotting the danger zones. What about offense? What does the analysis suggest investors should do instead to build a dividend stream they can actually rely on?
The number one theme, overwhelmingly, is prioritize sustainability over just grabbing the highest yield number. Strategy 1, favor quality over yield.
Meaning look for the strong businesses first.
Exactly. Find companies with solid fundamentals, strong balance sheets, fortress balance sheets is a term sometimes used, and a proven ability to navigate economic storms. A reliable, maybe even boring 3.5% yield from a company like that is way better than a shaky 9% that could disappear tomorrow. Focus on the underlying quality of the business.
Okay, quality first. What else?
Strategy 2, reinvest dividends in quality companies. Use compounding to your advantage.
Let the snowball roll downhill.
Pretty much. Take the dividends you receive and buy more shares of those same quality companies. Each new share earns more dividends. It's incredibly powerful over the long run, especially if you're reinvesting when the market dips and shares are cheaper.
And diversification, which helps avoid risk, also helps build resilience.
Absolutely. Strategy 3, diversify. Don't put all your income eggs in one sector basket. Spread it out. Mix some stable defensive sectors like healthcare or consumer staples with maybe some carefully chosen cyclicals.
Yeah.
And if you go international, just make sure you really understand those tax and currency risks we talked about.
What about managing the income flow itself?
This is key. Strategy 4, keep a cash buffer. Don't become 100% reliant on dividend checks for your essential bills.
Because they're not guaranteed?
Never guaranteed. Have a separate cash reserve, an emergency fund, whatever you want to call it. You need that cushion in case one or more of your dividend payers hits a rough patch and has to cut.
And finally, don't just set it and forget it.
Right. Strategy 5, regularly review and trim. Be an active owner even if you're a long-term investor. Check in on your holdings, maybe quarterly. See how things are going. And if a company does cut its dividend or gives really weak guidance that makes you worry about the dividend's future,
Don't just hang on hoping.
the analysis suggests you should be prepared to act. Maybe trim the position, maybe sell it entirely. It can be tough, especially if you've held it a long time, but sometimes you need to cut your losses before they get worse. Don't wait for a second cut.
This whole deep dive really hammers home that building reliable dividend income isn't passive. It's not just about picking the highest number.
Not at all. I think the core message from all the material is the worst dividend disasters are usually predictable, or at least avoidable if you're looking for the signs. It means not getting mesmerized by a high yield, not getting too comfortable with past performance, and not being blindly loyal to a famous brand name.
Because, bottom line, for an income investor, a dividend cut is a pay cut. Simple as that.
Exactly. It requires vigilance. It requires a healthy dose of skepticism. There was a pretty blunt line in one source. Something like any good worker, you should fire any employer who stops paying you.
Wow, that's direct.
It is, but it frames the mindset, right? It emphasizes being prudent and protecting your income stream.
So wrapping this up, what should listeners really take away as they think about their own dividend investments?
I think it's about shifting focus. Prioritize the fundamental health and the sustainability of the payout over the flashy yield number. Apply that skepticism we talked about. Use the tools available. Watch for those specific red flags we outlined today. Don't just cross your fingers. Actively manage the risk.
The analysis left us with a really powerful closing thought. It's not the yield you collect, but the yield you can count on that builds lasting wealth.
That sums it up perfectly. Be vigilant, be skeptical, and focus on the quality that ensures that income will actually be there when you need it.